Hey everyone, thanks for being here. Welcome to Options with Hans. I'm Hans Albrecht. I was a pro options market maker for 15 years and an options income fund manager for a decade after that. $1 billion in option strategies managed. Please like and subscribe down below and grab my free ebooks in the description. And again, if you do, I'm going to also sign you up for my free 4-day options challenge course that dives into ways to approach selecting great companies that are acting well and, of course, the right options to generate income, but smartly and with risk in mind. It's all about offense and defense. You've never seen anything like it. You get the good stuff here for free. But as always, this is for educational purposes only. Your trade, your responsibility. So if you're okay with that, let's keep going and dig right into a follow-up on our SOXL trade. This is a fast-moving area right now. We may have to do more updates soon. The horse is leaving the barn, and I want you to know that I love this stuff. I've been managing funds for a very, very long time and covered the AI theme for many, many years, managed tech. I've been interviewed in dozens of articles about AI. I've written on the topic for publications. It's going to happen. It's happening fast, and incredible wealth, again, is going to be made. It sounds sensational. I don't mean for it to come across as that, but I'm really getting excited about it, this particular leg, and it's happening right now. So let's learn about it. And as always, if AI is coming for our jobs, we might as well be hedged by owning those darn companies that are doing the dirty work. Okay, so let's do a recap of the trade that we talked about a couple of weeks ago, 12 days ago. So the idea was to put on this turbo trade. We're going to finance some of that upside, sell 10 contracts of the Jan 2026, right? Not 2025, 2026, the $12 strike for around 258. Buying 10 contracts of the 23 strike call, same expiry for 255. Now, these prices were available, in fact, got a lot better, in fact, because we did get a pullback in NVIDIA and the semiconductors in general. But I said, listen, I think this is good. You want to add on pullback. So you could have gotten even better prices there. Let's talk about the outcomes here. So as of Friday's close, we can see that we're up 50% on that first trade. So they're marked at 385. That's the bid, right? You always want to mark to the bid. If you're long something, you want to mark to the offer. If you're short, if you're short something. So 385 from that 255 on the long contract. So 50% on that one. And then on the other one, that's risk of 2550, right? Your risk is basically the premium that you've allocated to this, the premium you've spent. And so on the other side of the trade, you have these puts that you've sold at 258. They're down to an offer of 182. So this is where you could cover them. And so that's 8% on that risk. You're up 8% on that one. You're up 50% on the other one. Now, don't get me wrong. This is a volatile sector, right? We are diving into areas that are going to move around, that are going to be subject to macro events, things like that. So no question, we've talked about the risk. So those are the trades there. And then near the end of the video, we're going to talk about how I think this is still in play, and I've got some new ones for you. Okay, so what did Jensen just say? Well, exactly what I've been talking about. I hope you've been watching all my shows, my videos. Inference, insight, monetization of AI is upon us in a very big way. Now, I'm not counting out training at all. I think there's still going to be a massive amount spent on training CapEx, right? Buying all the equipment that is going to keep people up to date in terms of training and keep up to date with AI, because this is now a massive arms race, right? You saw the news from the Saudis, you saw the UAE. That means continual building out of data centers, GPU proliferation. Some people compare it to the nuclear arms race. I think that's an okay analogy, but it's a bit ominous, right? The nuclear arms race was kind of senseless, wasteful. They really, really overdid it. This is an arms race that no one can ignore. It's not just two countries. It's going to be most countries. This is quite literally a panic to get in. And I think you're going to see that panic actually ramp up over time. And we're starting to add really, really interesting names to our Hedged LEAPS AI portfolio. We've got the Hedged Leaps portfolio. We've added the AI portfolio. I want to show you a couple names here that are pretty cool. So we got one name here that took off. We added it on June 4th, 1930 on this particular call. 2 days later, it's already up 45%. So now, this is the nature of this basket is going to be a lot of very solid, dependable, foundational type names, but sprinkled in with a very healthy portion of the names that can really give us those insane kinds of returns potentially, right? So, I'm not throwing a party because I'm up 45% on this option in 2 days. It could disappear very quickly. But the idea is that if you've got a sort of strong conviction that this thesis is going to play out, it's one where you're going to have to stomach a little bit of movement and things are going to get going in the right direction, hopefully. So this is not an arms race that anyone can ignore. I just see this getting bigger and bigger. Disruption is absolutely massive out there. Another trade here we got in yesterday morning. So these are I'm showing you the comments here that you get in the service. So I'm going to talk about that service that you can get in on to take part in this. You get those real-time trades. You get exactly what we're doing. And you can see this particular name we got in yesterday morning, just as it was starting to break out. I think this is a very important indicator. I'm going to do another video on this specific name. I think it is a very good indicator that the thesis that this next leg is upon us and getting going is really happening, right? So this is a stock that can absolutely turn around and go the other way, but I think that is not the case this time. So, okay, so back to business. AI is going to need a lot more computing power than ever before, right? 1,000 times more. People sort of talk about AI, it seems very hyped, but I actually think it's quite underhyped in terms of what it's going to accomplish and how big it has to get, how much it's going to proliferate throughout economies, throughout companies, and throughout our individual lives. So and it takes amazing computational bandwidth, which is actually going to put a big strain on the power grid. There's just not going to be enough power. So that's going to be another topic for another video. So when we sort of look at how things have gone, 2023 to 2024, chatbots, which that's when the sort of rise of AI kind of rose from obscurity again. We had that big period in 2016, 17, 18. Then blockchain kind of took over for a bit, and then there was kind of a bit of a quiet period in a way. 2021 was a little bit bigger, but now this has got that next leg that really has some heft behind it. So now we are seeing this important rise of reasoning models. These AIs don't just spit out answers. They think, they double check, they fix errors, they do all this great stuff. But that is very demanding behind the curtain, right? They use way more data. We call those tokens. You might have heard Jensen talk about these tokens as sort of chunks that it consumes in order to train. Every word, punctuation mark, symbol, etc. 1,000 times more than older models, right? So this inference stage is actually very power hungry, very compute hungry. NVIDIA, for example, and it has competitors, the H100 chip was kind of that gold standard until now. So now you've heard of Blackwell, GB200, 40 times faster than the H100. So these things are rising in capability at an exponential rate. It's really quite amazing. So basically what it is kind of, I don't know if you guys have seen Spinal Tap, but there was the scene where they got it, if it's not loud enough, we just turn it up to 11, right? It goes up to 10, but they actually have 11 on their monitors, on their speakers. So NVIDIA says infrastructure spending could hit $1 trillion by 2028. It's unbelievable. This is almost mind-boggling. Their revenue is booming, and this is what is setting off this next stage, right? They are not just chips. The most underrated part of NVIDIA is their software. The ecosystem that is basically run by CUDA is very important. And it's very difficult to switch away from it. So developers have written, hundreds of thousands of programs basically that use this CUDA, right? So once you sort of become almost the standard of AI of the AI ecosystem, it's very difficult for people to leave. You can port to AMD, but apparently it's not nearly as good. It's missing a lot of features, things like that. And why would you? It's expensive to do something like that. Yeah, the AMD GPUs are cheaper, but it's just not, in reality, that doesn't make sense. So NVIDIA has this amazing franchise. And the stock is trading below its 10-year average valuation. which is actually amazing. People think it's really overvalued, and it isn't, given the growth that we're seeing out there. It's cheaper than some kind of pedestrian stocks like Walmart and things like that. It's actually an inexpensive stock. It has been met with a lot of skepticism. Take a look at this. Look at this. NVIDIA options is a percentage of S&P 500 single stock options volume. Look at that. Massive, massive amounts last summer. 45% of all daily options of single stock options were NVIDIA's. And they've come down and down and down and down. I like to see that. I like to see that this is not an area that people are necessarily that excited about. Okay. So let's talk about risks. Of course, we have to talk about risk. There is no sure thing out there. So risk to NVIDIA specifically, China export restrictions are very much a thing that is an ongoing concern, can go in either direction. It changes with the direction of the wind, basically. Concentration with big customers, possible. I think they're going to overcome that problem over time. Political strategy could backfire. Well, that's a tough one. We don't know exactly what the strategy is. We know that Jensen is sort of, pushing back at Trump and trying to sort of, make it seem like, he's missing out. He's going to let China win if we don't, align ourselves properly with certain foreign entities and things like that. So, and of course, he wants to push his chips into China. So he's going to work that out, right? They may make a simpler version for China, something like that to kind of assuage those fears. Risk to semiconductors in general. It's a cyclical sector. You know what? I think it is. It has to be to some extent, but I think this is quite horse out of the barn. This is becoming a necessity, not just a nice to have, it's a sort of need to have. It's like electricity, it's like running water. These things are going to be integral to how industries and companies actually operate. A lot of names are up 40%. Yeah, we've had a really, really nice big bounce in this area. It is very volatile. We could see a very quick 20% sell-off at any point. Macro could drag. This is a real thing. Macro could drag. Yields are pushing up. We hope nothing breaks again on the fixed income side for something yield related, dollar related, yen carry trade related. Anything can happen. And of course, not all players are created equal. Well, why am I mentioning that? Well, because we're going to talk about a different way to approach this industry. SOX and then SOXL. So the SOX, 30 semiconductor names. I already went through this in the last video, so I'm not going to go through it in great detail. Chip designers, broad-based players, fabrication companies, right? Deeply tied. There's the physical fab companies, like NVIDIA doesn't make their own chips, which is great. They have a very high return on capital investment because they really don't have to put much money into it. So, and then capital equipment makers, right? So you have many, many different sides to the industry. Now, let's talk about SOXL. So this is an area that I don't love to trade a lot, but it is one that I've kind of taken on as a way to play this very, what I think is going to potentially be a very, very strong performance in this area in AI and tech in general. So SOXL is a 3-time leveraged daily reset ETF, right? So if we're trading options on SOXL, we have to understand that we're trading something that is based on the SOX, but is going to give you 3 times the performance. And I don't want to go over all of this again, but I have to mention that this thing, in a choppy market where there's lots of up and down movement, the underlying SOXL holding can actually have a kind of volatility drag, a kind of leverage drag, because it needs to be rebalanced every single day in order to give you that 1-day guaranteed performance. Because of that, on big up days, they need to allocate into that swap product, basically. They need to allocate more longs, and then if it goes the other way, well, they lose money. So a lot of up and down movement actually chops up the product to some extent. So this is the risk. You want to be involved in something like this when there is a clear, consistent trend where there isn't going to be a lot of volatility in the longer run. So let's take a look on the options side of things. You know what kind of gets me a little bit excited is when I look at option pricing and the long end of the curve. So when we talk about term structure, this is a little bit deeper dive. You don't have to know this stuff. You can jump right to the trade ideas later on. But for anybody who wants just that kind of deeper dive, this is your term structure. Basically, where are options priced now, in a couple months, 6 months, a year, et cetera, all the way out to Jan 2027. We can see they're cheap. They're getting very, very inexpensive. And here we can see these longer term options trading very near their lows of the last few years. I like to see that. when I'm getting involved in leaps, longer term options. Very nice to see. In fact, in some names, it's really kind of even better than that, making new lows in terms of those names. So shh, don't tell anybody, but these options are actually, now I don't mean they're cheap. They're relatively cheap, meaning the implied volatility is inexpensive. So the turbo trade, right? I love this trade because you're using option pricing to your advantage, right? You want to sell the expensive to buy the cheap. Sell the expensive to buy the cheap. That is where you're starting to put option pricing on your side. Okay, so let's go through these trades. So SOXL LEAPS trade only for high conviction trades, right? So this is aggressive. There's no question about it. But it is positioning yourself somewhere where that upside call skew actually isn't very expensive. And you have time on your side. You're able to sort of see this through a little bit, sit back. That's one of the nice things. Time on my side, as Mick Jagger's saying, really, really works in the world of options. So the single trade is going to be, I'm going to buy that Jan 2026 $24 strike call for $3.10. What's my break even on that? 24 plus the 310. So 27.10 is going to be that minimum it needs to get to technically. Now, this has a whole lot of time value in it, and it's going to last quite a long time. It's not going to have big, heavy theta decay, which is one of the nice things about leaps, right? You're kind of combining advantages of options with fewer of the negatives, meaning not as much time decay, with some of the advantages of investing, right? That little bit of a longer term view. So it's really a nice combination of those two concepts, which is one of the great things about leaps. So my target on this is a minimum of $60 on the SOXL. So if it gets to $60, basically it's going to be worth at least about, that call is going to be worth at least about 20, what is that, about $23? No, sorry, about $33. So my target on this is going to be about $60 at a minimum, right? So that could be about a 950% win at that point, because at $60, those things are going to be worth about $33 minimum. And depending on how much time there's left on the life of that call, you're going to have varying amounts of call value, of time value. So then the idea is to sell it out in quarters. So maybe sell at 45, 55, sell another quarter at 65, and then wait for about 80 for that last tranche to sell out. So kind of piece it out, right? That's kind of one of the nice ways to sort of get out of a position instead of just selling it all and then watching it continue to go up. If you have a good idea and it's going in the right direction, let it play out a little bit. Now you can do other things. I did an MSTR video where I turn things into spreads and things like that. So there's other more sort of sophisticated ways to kind of deal with things, but on a very simplistic level, you can just piece it out over time, or you can set a kind of trailing stop, right? So if it gets to, $60, you could say, well, I want to keep riding this if it's going to keep going, but if it gets down to $50, I'm gonna sell out my calls at that point, right? So you might look at the chart, you might say, well, listen, I think it's remaining above the 9 EMA or maybe the 20 SMA. You're in a nice uptrend. Let the trend play itself out, and if it turns around and something changes in the story or changes technically, then you can always get out. That's one of the greatest ways to kind of let things run a little bit, right? It's one of that's one of the big things is of course we all suffer from taking our wins too quickly and letting our losses run, and that's really the complete opposite of how you have to do things. So trailing stops can really help with that. Now our turbo trade, which is going to be the financed upside, is going to be buying those Jan 24 calls, 2026 24 calls at 310 to open. That's going to be about $6,200 in capital, just like the first trade. But now I'm going to finance that with a sale of 20 of the Jan 2026 14 strike puts, which are 310 bid. So I'm actually able to finance the full value of those upside calls. So in a sense, to the upside, I don't really have a cost. I finance that full value of that call with the put sale because I'm receiving $3.10 by virtue of having sold these puts. However, this is going to cost us about $21,800 of capital. If you include the 310 you've received, the remaining is going to be the $21,800 for this specific trade, right? So if you want to use that 310 to buy the call, then it's going to cost you that full $28,000 of capital. So that's the cost to kind of finance that upside. And you're basically saying below a certain point, you accept delivery of SOXL. But what you can do is you can use a sort of bailout strategy. You can say, well, if the short put hits a 60 delta, a 65 delta, I'm going to bail on that. It could cost you a little bit of money, could cost you a bunch of money, but if you truly want to play this in a way that, avoids having to take delivery of SOXL at any point, then you're going to have to implement some sort of risk management to this trade. If you just buy the call, then it's pretty simple. You can put a 50% stop on there. Maybe if it gets to 160, 170, you can just kind of get out of that position. Now there's my win-win method, which is you buy the call and you kind of wait and see how things work out. If it continues to go up, then well, you've kind of got this upside potential. Those calls should generally go up in value as the stock rises. If it goes against you, well, now you're going to get down closer to these puts that are able to finance that upside. So you can kind of almost, you either win because it starts to go and pay you and start to look good, or it goes against you and now you're getting a better finance, right? So maybe you can sell those 14 puts for $4 or for $50, or maybe you can move that strike down to the 13 or the 12. You can start to play with those parameters to give yourself a little bit more room to the downside. Now, if those puts, if they start to erode, at some point they will, or if the stock goes up, they're going to go down based on delta. So you can maybe aim to buy these back between 50 cents and $1, and then you take the risk off of your book to have to buy SOXL, right? So there's nothing wrong with taking some of that risk off the table over time if it presents itself. So I would sort of, I would kind of set a target of maybe $1 where you start to cover those and then all the way down to 50 cents. So remember, time is on your side. You have this ability. So when you trade short-term options, there's a lot of pressure, right? You have to be right away. You don't have the luxury of being able to let things play out. One of the great things that we can give ourselves as traders is we can give ourselves the gift of time, and Leaps give us time, give us the ability to zoom out and try to find these longer term trends that we can take advantage of without feeling the pressure of that daily theta erosion, right? That sort of daily pressure of, oh my goodness, if this doesn't happen in the next week, if I buy a 1 or 2 week call, every day is costly, that stock doesn't do what I want it to do. So hopefully you guys learned a couple things from that. I'm going to start doing this. I do have a lot of exposure to the sector, to NVIDIA, to SOXL. I actually own SOXL stock as well. So I've got a good amount, but I'm going to continue to add as this looks better. So in our community, in our trading room, somebody was asking me on Friday saying, listen, should I keep adding to this? I said, very, very close, right? The SOXX is starting to look really, really good. I can see another potential leg up. There are some macro issues out there. So it's an area where the market is overall a little bit fairly priced. It's not undervalued. But again, in my macro assessment, which I did yesterday or a couple days ago, you can read, you can listen to what I think of the general overall market and see how you feel about that. There's potentially a chance that we kind of spin our wheels perhaps over the next 4 or 5 months. But again, I think this is an area where companies just kind of have to keep spending. They have to keep allocating to it because they don't want to get left behind. They've got to keep up with the AI Joneses, and that is going to be a strong theme, in my opinion, over the next couple of years. So enjoy, safe trading, and we'll see you in the next video.